everyone, Chaps here, and let's talk investing. As usual, before we get started, I'm going to put out that normal disclaimer. I didn't go to school for finance, I'm not certified in any finance-related fields, and I'm relatively new to this. That said, I've learned a lot over the past year, and while I can't say what's best for everyone, it's unique to each individual, what I can do is discuss some of my learnings. By far the most advantageous way to get into the market is by investing in stocks and bonds in some form. So today, I'm going to start by talking about what is a stock versus what is a bond, and then I'm going to go into what are the different account types that you can use in order to get into the market. Then in the next video, I'll discuss some of the main vehicles for investment. You can think mutual funds versus ETFs and a little deeper into stocks and bonds, as well as what are some of the investment categories. You can think low cap versus high cap, growth versus value, domestic, international, things like that. And then in part 3, we're going to discuss investment strategies. How do you invest? Do you have someone manage your money? Do you do it yourself? What do you look for in investments? Today, I'm going to be focusing on the most common account types. Sure, there's some less common ones, but this video is really intended to pave the foundation for understanding the investment landscape. So with that, let's start with what is a stock versus what is a bond. When buying stock, you're buying equity in a company, as in you now own part of the company. Granted, with most companies, there's so much stock out there that your slice of the pie is pretty insignificant, but hey, you're a partial owner. If the company does well and the price rises, you make money. If the company does poorly and the price drops, you lose money. Bonds, on the other hand, can be seen as a loan. You are actually loaning a company or the government some money, and they'll pay you back with interest over time. For the most part, these can only go up. They're safer than stock, but often have a lower return. At a high level, that's really all you need to know about stocks versus bonds. Stocks are ownership in a company, and it can go up or down. And bonds are a loan to a company, or the government, I guess, and they mostly just go up. So now you decide you want to invest. What types of accounts do you need, or what types of accounts can you have in order to invest? Well, the most basic account is your standard brokerage account. You open this as an individual or a joint account, and through these you're able to invest in basically whatever you want. There's various brokerages out there, but some of the most popular ones are things like Fidelity, Vanguard, and Schwab. Next, we have some retirement accounts. You'll often find these more advantageous to use over a normal brokerage account due to some of the tax advantages you get. They do have a few more rules and regulations around them, and it's important to note that you likely won't be touching any of the money or gains in this until after you're 60. So the first retirement account is the IRA, or Individual Retirement Account. This is an account that is set up for an individual to help them save for retirement. This is an account that you set up yourself through your brokerage of choice. With an IRA, you can choose either a Roth IRA, in which your earnings grow tax-free, or a traditional IRA, which can reduce your taxes in the short term. Essentially, you're going to get a great benefit by having this account over a non-tax advantaged account like a traditional brokerage account. There are limitations on how much you can contribute though. For example, in 2023, the IRA contributions are capped at $6,500. This number is even smaller, or could even drop to zero, depending on how much taxable income you were bringing in. Just as with a traditional brokerage account, you're able to invest in any stocks or bonds you wish from within this account. Again, that's a very high-level view of Roth and traditional. I have an entire video dedicated to Roth versus traditional if you're trying to figure out which one is best for you, so go check that out, it's linked below. So the IRA is a retirement account that you set up, but there's also some employer-run retirement accounts. Most notable is probably the 401k, or the other defined contribution plans as they're called, like the 403b and 457b. I'm mostly just going to refer to the 401k here as I feel that's probably the most common. These are tax advantage accounts that are set up by your employer. The key here is that they're set up by your employer so you don't get to choose which firm it's through. Again, just like the IRA, you can have Roth or traditional, here it's called pre-tax contributions. Some employers also offer an after-tax bucket, but we'll ignore that for now. It's essentially the same as a normal brokerage account, but being held under your 401k. There's a few big differences between IRAs and 401ks. To start with, you're likely eligible for some company match in a 401k. That is, you may find the company is willing to provide some bonus cash to your plan. That could be something along the lines of, the company will add 50 cents for every $1 you contribute, up to 5% of your salary, or something like that. It's essentially free money and should totally be utilized. I guess I should mention that these defined contribution plans also differ from an IRA because of the way that the money is put in there. Unlike an IRA where you are just investing the money as you please, with a defined contribution plan, it's taking money out of your paycheck. So you set a number, let's say 6%, and then every paycheck, 6% of your money, along with whatever the company is matching, will go into this retirement plan for you. The next major change is the contribution limit. If you're under 50, in 2023, the contribution limit to these various defined contribution plans, like the 401k, is $22,500. That's much higher than the $6,500 limit of the IRA. The last major change between an IRA and a defined contribution plan is what you're able to invest in. As I said earlier, with the IRA, you can basically invest in whatever you want. But with a defined contribution plan, like a 401k, the employer is the one setting up the plan, and they only have a select number of things that you're able to invest in. Some of these may be great, and you'll get some really nice rates on them, but other times it could be a little limiting, so it really depends on your employer. The last type of account that I want to discuss here is the Health Savings Account, or HSA. This has a much lower limit of $3,850 in 2023, but it can be used to cover healthcare costs. Once again, this is a tax-advantaged account, so it's probably going to be more beneficial than your standard brokerage account. This isn't a retirement fund like the 401k or IRA though, so you're able to withdraw the money as needed. The withdrawals must go towards an approved medical cost though. This starts as basically just a bank account of sorts. It's not really earning much, but once you reach a certain balance, you're able to start investing a portion of this money, similarly to an IRA. That is, you can invest in whatever you want. Okay, so in summary, we have the standard brokerage account, which is your most basic account. It can be individual or joint, there's not really any limits on it, and you can invest in whatever you want. Then we have the retirement accounts, like the IRA, where it has a smaller limit and you control what you invest in. And then you have the 401k, which is employer run, deducts from your paycheck, and again, you do control what you invest in, but it's selected from a subset of what your employer offers. And then lastly is that HSA, where a portion of that health savings account is able to be invested in whatever you want, similar to an IRA, but the expenses can only go towards medical cost. Again, there's other accounts out there, but I think these are the main ones that people should consider when they're getting started. When you put money in though, it's not like you just put in some cash and it starts growing or going down. You actually need to invest in something. Stocks, bonds, ETFs, mutual funds. All of these investment vehicles can then further be broken down into different categories for what they represent. For information about those different types of vehicles and the different categories, check out part 2 that I've got linked down below. If you found this helpful, hit that like button, subscribe if you don't want to miss anything. If you've got any questions or if you think I made an error in here, please let me know down in the comments or hit me up on Twitter. Thanks for watching everyone, and I'll catch you next time.